If you were located in 49 of the 50 countries in the world, God bless you. You put 2/3 of your money in U.S. stocks. International investing has been a screamer.
And once a metric becomes a measure, once you begin tracking it or attempting to use it, then it no longer becomes an efficient metric.
I think most investors these days are actually pretty well behaved.
I think the empirical evidence supports the idea that you can learn almost nothing about the future growth of a company by looking at its historic financial statements.
I think getting your feet wet and learning through failing when it comes to investing is perfectly okay.
I believe that we spend far too much time as historians and not nearly enough time as futurists.
Options are not a derivative. They are the underlying.
I don't believe alpha exists over the long term.
You really don't need a catalyst. What you need is to get the valuation right and to get the governance right.
So Matt, today we're getting controversial.
Let's get controversial. I'm ready to, break a few Gregs and make an omelet.
You're going to be shocked by this, but when I had my Raisin Bran this morning, I had the Raisin Bran with the extra raisins. So I'm like in a completely wild mood. I've been out of control.
I've been living off of Irish soda bread and massive quantities of butter. So in a future episode, when I weigh 300 pounds, you'll know what happened.
We'll see what that will mean for your commentary as we move forward here.
I very much look forward to those comments.
So we have a standard closing question. We have a new one we ask at the end of every Excess Returns episode, which is, what is one thing you believe about investing that the majority of your peers would disagree with? And so what we're going to do today is we're going to take all the answers we have. We have 10 or 15 answers. We're going to go through them and we're going to quickly tell people what we think. We're going to play the clips and then we're going to tell people what we think maybe the key insights from them are. So we've got a lot to go through. And just before I get started, I do want to give credit to Meb Faber because we basically blatantly stole this from him. He had a tweet about this same exact thing, which was really, really good. And I would recommend people go follow him. But we saw the tweet and we're like, this is a great question to ask people because it's a question they never get asked. So thank you, Meb. We apologize for stealing it. To make up for it, we've actually included you twice in this episode, unlike everybody else who's in here once. Meb will lead it off and he'll finish things up at the end.
This is the only way to do it. We will atone for our sins. And hey, ante up, Meb. You come steal whatever you want.
So we'll start off by letting the dividend people go after Meb because they're one of the most aggressive groups on Twitter. So here's Meb talking about why dividends are overrated.
So, we wrote a book a decade ago called Shareholder Yield, A Better Approach to Dividend Investing. And that's a pretty ballsy subtitle, right? Because Morningstar did a recent report where they outlined, they were looking at dividend funds and there's over 300 of them managing over $1 trillion, right? So you're kind of coming at one of the most beloved brands and narratives of the past 100 years, right? And so we're updating this book, listeners, so hopefully it'll be out before year end, but you can download the last version free online. But in the beginning, we demonstrate, we say, hey, look, here's your return if you only had price return of U.S. stocks for the past 100 years, and here it is if you reinvested the dividends. Now, the key phrase in all of this is reinvested dividends, and I've been combing through a lot of the academic literature, and the consensus seems to be that most people don't reinvest their dividends, at least in the same proportion of what they invested in, and the fantasy I think most people have is of the dream, laying in bed, you're like, oh, I just can't wait till I get to Hawaii, sitting on the beach, drinking pina coladas, letting that sweet, sweet passive income roll in, right? And so there's nothing wrong with dividends. They are very much a part of the investing stream. But if you live in a high tax state, like I do in California, the last thing in the world you want is dividends and high dividends. And so do dividends outperform historically, meaning high dividend yield? Yes, they do. Now that factor, as we all call them, tends to put you in a little bit junkier companies, right? But it gives you this value tilt, which in my opinion is really what you're looking to get, right? You want to have that value tilt. But if you're going to do value, my opinion is always just do value. Don't do a cousin of value, dividend yield. And so there's a million different ways you could do this offshoot where, we wrote probably our least downloaded or read paper was one that was targeting no yielding stocks. And we said, hey, if you did a value tilt and targeted no yielding or low yielding stocks, you ended up with a higher after tax return in a taxable count than if you invested in high dividend yield or the broad market. so there's all sorts of different ways you can go this, but the whole key being that I think, the analogy we use in the book update, that's an old blog post, is we liken it to the old Coke Pepsi taste test. You guys remember that? So for the young listeners on here, don't know what this is, everyone prefers Coke. And if you do a blind taste test, most people prefer Pepsi. And, but then you reveal it, most people go back to Coke. And a lot of this has to do with branding, I don't know, commercials, marketing, what your parents, maybe you just like Warren Buffett, big Coca-Cola drinker. Anyway, I think it's the same thing was true with dividends. They have a great narrative, a great story. Don't even get me started on buybacks, because that's the next 50 minutes of this discussion. I'm trying to keep these short because we got 20 of these, but if you do the whole column list of things that are horrific, terrible, no good, very bad ideas, and the other list is things that are probably totally fine. Look, dividend investing is totally fine. It's not the worst thing in the world. But if you get me into is this optimal question, and why are there better choices? There's certainly I think better choices and better ways to do it.
So I mean, he's right about this. Just from what he said and from the perspective of the data, I mean, dividend basically is a subpar value metric. People love, they think they're getting magical money. They think they're getting, free money, all those things. But at the end of the day, there's better ways to run a value strategy than dividends. And there's better ways to create a dividend than necessarily having to get it paid to you.
Why do you want to pay taxes? Don't you want to just drink pina coladas on the beach or whatever the story is? If you're going to realize
West Gray
income,
approach, basically.
Yeah. If you're going to
no
realize
taxes and pina coladas. It's the way to go.
There you go. Puerto Rico all the way. I'm sure that's all he's doing all day, every day, is drinking pina coladas. But seriously, like, if you want income, then you accept the tax penalty of doing that when you're taking the income. Maybe not tax penalty, except the reality of taxes of this. But if you don't need the income, then like, why are you emphasizing this? I couldn't agree more with Meb on this take.
So this next one is Mike Green, and we actually kind of unfairly penalized Mike Green, because the answer to this question for Mike Green should be that passive investing has influenced the market, because he's basically the one that came up with this. But it's become so part of, common knowledge now that he couldn't say this one, so he had to come up with another one. So here's what Mike said.
It's a lot harder today, right? Because if you'd asked me 8 years ago, this is the same question that I was asked by Peter Thiel, in which I introduced the concept of how passive was changing the behavior of markets. I honestly think most in investing now would actually acknowledge many of the points that I have emphasized and made around that. On the investment front, I guess what I would really highlight is an element of Goodhart's law, which is once a metric becomes a measure, once you begin tracking it or attempting to use it, that it no longer becomes an efficient metric. You've actually changed it by its participation. And again, I highlighted this in my Substack. I think Austrian economics is largely bunk. Right. I just want to be very clear. I think there's a deep misunderstanding of what money is in Austrian economics. But there is a really important concept in Austrian economics, which is that we are all acting individuals. We are not passive participants in our lives or in the universe that exists around us. We tend to look at cycles from an anthropic principle, which is to say, the world exists, right? And these cycles have played out through history, and therefore they will play out in my lifetime. The reality is those cycles were actually created by the actions of individuals who either resisted the cycles, amplified the cycles, tried to turn the cycles, etc. We've become so passive as a society that we're terrified of any attempt at action. And as a result, we're passively sitting by and saying, well, the cycle's going to play out. No, if you don't act, the cycle's going to be different, and it's probably going to be worse. And so I would just emphasize that, like, we should all be stopping and thinking at every stage in every action that we do, is it an intentional act to make the world a better place? And I don't think markets tell you that. I think the participants in the markets tell you that.
I love this idea that once a measure becomes a metric, it doesn't work as well. And like this applies where I operate too, in the world of value investing. Like if you think about the price to book ratio, like once a lot of people start using a specific thing, the value of it goes down.
I always think about this from a musical perspective. Once you call something a movement, you've basically killed the movement. So very famously, like in the 90s, a lot of the stuff that I loved turned into, roughly around the year 2000, Vibe or The Source does this issue on the Soulquarians, and they get all the musicians I love that are all collaborating with each other, making all this amazing music. They get them together for a cover shoot. And what happens after they do the cover shoot? They all stop collaborating. Like once you label it, you kill it. And I think that's what Mike's saying here too.
It's funny because Matt's always ahead of these musical trends, and I'm probably the one who's jumping on at the end. So like once I like it, Matt's probably done with it, and he's like, "This is exactly what you're talking about."
No, this is the problem with this is like I still listen to those albums from like the late 90s, early 2000s when they were in that prime of all the Dylan, D'Angelo, and wonderful, wonderful stuff, and I hold on to it like from my cold dead hands. You'll take those like 10 years of records away from me.
So sometimes when we ask this question, people slip in too, and Jim Paulsen did that. So here's what Jim Paulsen said.
I talked about one of them earlier, just that I think that the policy officials, monetary and fiscal policy officials maybe are nearly as important as we think, that other important drivers should work. Mainly just the independent decisions being made by, laissez-faire, if you will. And I think that's what people miss. They spend far too much time wondering whether the Fed's going to cut or not, or what tax policy is going to be passed. And I think while they're doing that, a lot of economic policy is being implemented every day, every hour, every week. And that's probably more important in driving things a little bit. I think the other thing I talked about was valuation losing its import, which I think most people think I'm nuts on going there with that. And then I'd also maybe just say too that in many ways, I think Main Street sentiment, cultural sentiment, what I call it, is far more important for investors than Wall Street sentiment. We have a lot of bull bear indicators and that kind of stuff, but I think what the real potential or risk of the stock market a lot more often has to do with culture sentiment on me.
These were two strong ones. Monetary and fiscal policy officials aren't as nearly as important as you think, and valuation is less important than many people think as well. I'll take the second one. I think that's true. I think first of all, I think people think of valuation as something different than what it actually is, which is that it tells you something about the short term. So that's always been true. But I also think in Mike Green's passive work is definitely something that informs us around this. I think the market maybe is a little less concerned about valuation than it used to be.
Business is doing business. Like that's the fundamental thing that you got to remember here. Valuation is just a snapshot. Who the Fed official is, who the Treasury official is, like those are just people holding a temporary role. Businesses who figure out how to do business, stay in business, and grow their business over time. That's kind of the whole story at the end of the day. And it's a really grounding principle. I really, really love the way Jim frames this up.
So this next one I'm going to throw to you right away once I play it. But this is Ben Carlson talking about investor behavior.
I think most investors these days are actually pretty well behaved. And I think a lot of people look at like mom and pop and retail investors and think, oh, they're the idiots, right? They're the ones making all the mistakes. And those people do exist. But I think investors are far more well behaved these days than they've ever been at any time in history of investing. Because I think we have all these different avenues. We have automatic investing in 401ks and IRAs and tax loss harvesting and robo-advisors and target date funds and all these things and index funds. And I think the general investing public has gotten better at investing than they were in the past. I don't think a lot of pros actually believe that.
So this actually is a pretty controversial take, Matt. The fact that a lot of people think, with Twitter and, all the other craziness going on and Robinhood, that people are actually a lot worse behaved than they were historically. Ben thinks they're better behaved.
I think the thing that Ben has going for him in this argument is not so much just in the investor behavior, but so yes, we have like Robinhood with confetti and whatever I think they stopped doing, and a lot of like the degen subreddit, zero DTE option shenanigans that are going on. It's a very small portion of the overall population that's getting into this type of behavior. Most people have access to professionals who in record numbers operate under a fiduciary standard or something where they're not just hawking BS product at them all day. And I would like to think that a lot of people have just access to better tools, better information, and better quality of advice than ever before in at least American history here. So I do kind of side with Ben on this. I think some people do crazy stuff, but I think it's actually the minority. I believe him.
I hadn't thought about it that way, but because people have access to people like you and people like Ben, maybe people themselves left to their own devices would not be behaving any better, but maybe they are because of that.
I think about it from like older clients or people that I've worked with for like almost 20 years at this point. In some cases, I think about the beginning of our relationship when it was they're buying these awful closed-end funds and A-share mutual funds and just things that we look at and we're like, the fee bloat, the quote unquote active manager charging him some astronomical thing with a sales commission on top of it. Like all that stuff was horrible. And they survived 30 years of doing it before like they got it converted. And now they're 80 years old doing something else and really focused on what matters and more low cost options and everything else. It's like changing your diet over time. And I think we have seen a giant shift in that for the average American investor. And I do think Ben's right about this. I really do.
So Dan Rasmussen is the king of these types of takes. And I thought he would have gone private equity here, but he did not go private equity. So here's what Dan said.
I think it comes back to something I talked about at the very beginning, which is sort of core to my worldview, which is the predictability of growth. And I think that most investors implicitly or explicitly believe that historic revenue or EBITDA growth is predictive of future revenue or profit growth. And I do not think it is. And I think the empirical evidence supports the idea that you can learn almost nothing about the future growth of a company by looking at its historic financial statements. And I think that is the most controversial thing. And I think the implications of it are so massive that I'd say that that's my greatest point.
And I think the most important take is this idea that you can use past growth rates to predict the future. Because I think most people think, and understand that growth rates cool down over time. But what he's saying here really is past growth rates have nothing to do with what happens in the future. And that is a controversial take.
I think about this one as past fun does not equal future fun. Like just because you had fun before, sure, you and your friends were hanging out a little bit too late, drinking too much coffee at Perkins and then pushing each other in, shopping carts through your random mall parking lots. Like that's a good time when you're 16 years old. That's not such a great idea when you're in your 40s. I might still have to try. It might be a good time. But the idea is like your past fun doesn't equal your future fun because just stuff changes over time. You can't index it the same way. When we look at these companies who have experienced exponential growth or huge things, you got to ask questions about where they are, extra Aswath Damodaran in this stuff too. Where are they in the life cycle? How do we expect that type of fun to show up again at this phase of their life? Dan's raising a ton of great questions with this comment.
Well, yeah, if you were thinking about if you were ever to go out one night and have a few too many drinks, the past fun does not equal future fun would apply to the next morning, I believe.
Yeah. You and I are both probably at the phase too, where it's like I could have the mocktail and I have a worse headache the next day from the friggin' sugar in the drink than I do from if I had drank the bottle of whiskey.
I'm like a max 2 drinks guy these days. Like, anything more than that, and I'm like, yeah, I'm like useless the next day.
Yeah. All right. Lessons learned. Thanks, Dan.
So this next one is from an interview you just did with Lindsay Bell and Shannon Saccocia. So here's what they said to the question.
I think it kind of relates also to the individual investor. And I think you and I kind of talked about this. What I would say is that most people fail into investing. So they don't read the book and they don't learn to do it the right way that all of us are here to help educate people to do. They don't hire an advisor. They just put money in the crypto coin that their neighbors are talking about. They buy the meme stock or maybe even buy a good stock and then they learn along the way. And usually it's through failing that you realize, oh, I have to learn how to do this the right way. But you got to get your feet wet, right? And so I think getting your feet wet and learning through failing when it comes to investing is perfectly okay. Only if you're doing it in small amounts, though. You can't just put it.
Don't fail too big, but failure is actually maybe one of the most important ways to learn investing. I love that. All right, Shannon, this is you. What's one thing you believe about investing that the majority of your peers would disagree with?
So I will preface this as saying that I went to school and I got degrees in history and economics. So, but I believe that we spend far too much time as historians and not nearly enough time as futurists, as investors. So I think anchoring to these periods, having experienced them, there are so many things that have happened in history that were point in time that if you put the actual context around, you realize that they may be not at all applicable to what you're experiencing today. And so I think in order to actually be a successful investor, you have to think about what might be instead of what's happened in the past.
I like both of these. I'll take the first one. This idea of failing into investing is okay. Like I love this idea because so many people think it's important to prevent like all the mistakes earlier in your investing career. And I think the reality is when you have less money, it's probably great to make the mistakes because then you end up not making the mistakes when you have more in the future.
And I love what Shannon says here about investors should be futurists instead of historians. Like she's got the economics and the history degree. She studied this stuff, but she knows if you're just hung up on this, and I hope she's not just beating up on you as a quant. Maybe that's all you wanted me to take the second part of this. But it's like, if all you do is look backwards, you're going to fail to start to imagine what that future could be like. And as investors, that's a real huge part of our job, to think about what does this future look like and how do these pieces of my portfolio fit into it.
Yeah, it was a little painful as a quant to hear that. So this next one is from Cem Karsan, and neither you nor I is going to have an insightful take on this, but I think it's really interesting and it's important because options have been rising a lot in terms of how much they're used. So here's what Cem said.
Options are not a derivative. They are the underlying. When people refer to options and all the volume increases and wow, the phrase that everybody uses, it's wow, the tail is starting to wag the dog. I'm here to tell you that options are the dog. What do I mean by that? Well, pretty simple. If you look at a stock or a bond or any asset, right? People, it's two dimensions. It either goes up or down. What if I gave you two stocks, white labeled, no name on it, same market cap, same industry, same everything? You would say, well, those are the same stock. What if I peel back that option train and show you that one is incredibly right distributed with a left tail, the time which that distribution is completely different, and the growth trajectories are different. Whereas on the other one, it's the exact opposite, very much a value stock, maybe left distributed, right fat tail in case they come up with a solution, completely different stocks. The actual options are giving you nodes and probability across the full distribution of what this thing looks like. At the end of the day, that asset, whether it's a stock or a bond, has a full three-dimensional picture of its characteristics of what the asset is. The asset itself is the thing, not the stock price, not the asset value. The asset value is just a summary of that full distribution. By arbitrage, every node on that distribution that represents this asset is summarized by one price, which is the asset price, the stock value, the bond value. Everybody started in that asset value, that very simple two-dimensional world. And derivatives are new, so we call them derivatives because they're derived from this thing. But the reality is they're not a derivation. It's a better technology. It's a better way to we're going from a two-dimensional sheet to, a hologram. You're seeing the whole thing in its full essence. And the reason it hasn't been used more until more recently, but again, we've seen secular growth since I've been in the business for 25 years, and it's been exponential. But the reason is because of network effects. Much like a technology, even if it's a better idea, you need to build infrastructure and you need more volume and you need more participants for it to be an active and to become the core thing that everybody uses. What have we had in the last 25 years since I started in the business? When I started in 1998, we had one quarterly expiration in the S&P 500, and options were priced at every 3 to 5% in the market. That's it. Now we have every day. And by the way, the multipliers were 250. We have every day expiration. We have every 5 points in the S&P. We have options for every single major equity and every single asset across the world. We have more education. We have access through brokerage and regulation has thinned out to allow much more access. Not to mention we've gone from 250 multiplier to 100 to 50 to 10 to 1 to now 0.1. It is incredibly available now, and people are beginning to get educated, understand. But the reality is we're still at the tip of the iceberg. It is a superior way to position based on information that you have on any asset. You can express any point without taking the full risk of the whole asset at any point in time or moneyness on that asset. And that is just a superior way to express information. So my view is that the world is going to options, and that options will be the primary way to invest in the future. And whereas even though notionally there's more trading volume, and realistically it's still 1% of total investment that happens in the market. And my belief is that if you look forward in 20 years, 40 years even, we will be in a completely different world where options sit at the core of investing.
I don't have a great take on this. I do agree with him. I mean, options offer the ability for people who know what they're doing to express different views in more of a three-dimensional world versus a two-dimensional world. So I've never traded an option. I don't know if you have. Have you traded an option?
I have traded options mostly on behalf of clients and some for myself, but not like,
Okay, yeah, I've
not
like
crazy
never
traded options. Like,
I've never done it on behalf of anyone. But nonetheless, I think it is important, like for all of us to keep in mind, like as options rise in importance, as more and more people use them, and as more ETF products come out that use options, like this is part of our lives now, this option stuff. And so it's important just to think about what they are, how they work, and how they influence what we see on a day-to-day basis.
I do relate to the stocks in this scenario. I have 2 dogs. They have a mind of their own. When I take them for walks, like they have ideas and plans for the walk that we are about to go on. So even though I'm in charge of feeding them and taking care of them and picking up their poop and all the other important, dog parenting obligations, we get to an end of the block. And if my dog Otis looks up at me and he'll just walk into the middle of the road, dragging me by the leash. He's just like, no, we're not going down that street this time. And if that's what options are doing right now, according to Cem Karsan, I'm sympathetic to that view. Sorry, stocks. I'm right there with you.
So this next one is definitely true. The question is whether it's controversial. So we'll get into that after. But here's Andrew Beard talking about why simple is better than complex.
Simple usually works better. Yeah, I mean, I think people think that hedge funds. I think people think hedge funds gravitate to complexity because it's necessarily better. The very best hedge fund managers and investors that I know, it comes down to simple bets. And the geniuses are the ones who can see through all of the noise to what the fundamental underlying bet is. And as it relates to our business, we made a simple bet. We made a simple bet that we could accurately figure out the big exposures in such an efficient way that we would have a structural alpha advantage by cutting out what we saw were a lot of fees and expenses. We wouldn't be right all the time, but but going back to that model of being right often enough. And if that works simply, why would you change it? But that's disappointing to investors. A lot of allocators, because they're so conditioned to hearing, and I end up always asking the question, like, look, if quants are so good, if quant models are so good, how come so many quant products are so bad? Right? If complicated products are so good, why don't they generate better returns in the S&P? So I think that's. I mentioned this quote about Renaissance, who's the quant investing gods. There's this great quote from one of the early statisticians who said, that their superpower in a sense was just doing these simple regression models, but they were pulling people who were doing field theory at string theory at Harvard to do, because it's about asking the right questions and getting it right and resisting the temptation, as you say, to keep, because with models people love to keep changing them. It's very, very hard, and there's pressure to change them because investors want to see that. And so, for years when we were talking about it, it was the fact that we weren't changing. It was viewed as being, we're being lazy, we're not paying attention, we're this, that, and it's hard. It actually ended up being a very contrarian bet, but I think people are coming around to it now.
So I do think actually this is probably a controversial take because so many people do think like adding complication to your investment strategy makes it better. Adding complexity to your strategy makes it better. And it almost never does. So I think he's probably right about this.
There's an expression I like to use with clients: don't get cute, get cautious. And not cautious in the sense of going and hiding, but like instead of trying to get cute about your expression of some idea or whatever else, what's the simplest, most cautious way you could put the bet on? So it might be you want to put on some crazy like crypto whatever thing, but you can go like, all right, is there some other way I can reverse engineer this and express this in a more simple view that doesn't require me to get 16 types of, weird digital wallets to like implement this thing? What other way can I come up with this that's a simplified version of the crazy idea I had? I think he's onto something with this.
And also clients like this. I was talking to some advisors the other day and they were talking about like, we had a strategy that had like 5 ETFs. And they were saying, well, 5 ETFs is not enough for a client because a client wants to see like more going on. Or you've seen these single ETFs that do the asset allocation and like no advisors can actually use them because their clients look in there and they want to see some sort of complexity They don't want to see this easy, simple solution.
Yeah. And look, the reality is if somebody else is building it for you, you want it to have like, oh, here's how the watch is constructed with all these mystical things you can never imagine. But like if you order the thing from IKEA, you better be able to figure out how to put it together for itself. Or when the lamp that's on the floor behind me that I need to set up later today, the lamp that I ordered from Amazon, if that doesn't go together in like 3 steps, I'm going to be really mad. When somebody else is doing it for you, we're like, oh, complicated. You built a NASA rocket ship. But when it comes down to doing it yourself, like a lot of times, just make it clean, make it easy. Just get the lamp, turn the light on already. It's all you really need it for.
So if you want to get a series of deep insights in a very short answer to a question like this, you probably need to ask Jason Buck. And so that's what we did.
What just hit me, I think why I sound different is if we just use the word believe. And that's what I think the problem is. I think in our industry, people believe a lot of things that aren't true. And it's based on like insecurity, right? Like we're so desperate to manage our clients' wealth that we're looking at these historical representations and drawing inferences of them. And then that provides a belief system that then we think through. So I think about like things, there's so many things, I don't even know how to pick one. Is like, I don't believe alpha exists over the long term. I believe you combine interesting betas, obviously. I'm actually with Meb too. Like I think the Fed does a decent job. I don't know anybody else I think that argues like the Fed's doing a terrible job. I know 2 things. One, if they're a hedge fund manager, it means their P&L is down. And I'm like, you could trade with whichever direction you think they're going, even if you think they're wrong. And then I also think rates don't matter. It's just a hurdle rate, and everybody, like entrepreneurs are going to be entrepreneurs no matter what the rates are. They can't help themselves. Trying to give you a broad sample, but what it boils down to is essentially, I think it's really difficult what we do. And I think that if we're truly honest, nobody knows the future. Nobody has a crystal ball. And so I just think if I can hold most of the world's asset classes and rebalance, I should muddle along okay. And that's what I think the biggest lack of belief. I think it's more of a lack of belief that I have versus I'm always shocked by the things that people say in our industry, because I'm like, how do you believe that? How are you determining that? What's the base truth in what you're saying? And if you I feel like I'm a 6-year-old sometimes at some of these conferences. If you ask why 3 times, they tend to fall apart. And it's very interesting that, the emperor has no clothes. And, it's a really weird thing that like, the ultra wealthy and the aged just love to think they have a crystal ball to predict the future. And it's always kind of shocking to me. And I just find myself out of kilter in that way.
So Matt, I don't even know where to go with this. I'm probably just going to throw it over to you. Like alpha doesn't exist is a good one. He's talking about like nobody knows the future. There's a lot of things he's talking about in here, and they're all very insightful. So I'll let you go where you want to go with this.
The poet Jason Buck. I think he's basically just trying to point out that like everything we think we know about the past is just an artifact of the story that we've put together. So anytime we're going to go forward, we tell the story of the past by picking up all these dots and then go, oh, look at the neat pattern they made when we look back in hindsight. It's really hard to say, if not impossible, as he would argue, to say that like looking forward, we're going to have any idea what any of those narratives look like, because it's infinite possibility in front of us. And behind us, we just get to cherry pick the stuff out. So as always, Buck is just giving us, world religions and philosophy answer inside of something that was supposed to be a basic question, but iceberg Buck, that's what we get from him. You know what else is a hallucination? A book. It's on the shelf. I should have got it before the episode.
Don't break the book out again. We had so many comments about the book. The book's not real. The book doesn't actually exist.
Like alpha.
People looking for the link to Amazon to buy the book. I'm like, please, no more with the book.
Iceberg Buck. You're not an artifact in my mind. You are real.
So Ian Cassel had 2 lessons, actually. He had a lesson for his peers, although it wasn't, he said he didn't have much of a lesson for them. And then he had a lesson more for average investors.
I don't like, if it was pure peers for microcap that are also microcap investors, I don't think there's too many. I don't think there's anything that my peers who are also experienced microcappers would generally disagree with me on, agree with them on. I think that it would be just like a lot of things with investing. I think alpha is generated in a lot of small ways, where we agree, but it's just executed slightly differently. And I think that's how I'd answer that question if I was directed towards other experienced microcap investors. For peers that are investors in general, but not microcap investors, I would say probably, and we hit on this already, I think just the belief that low turnover is good and high turnover is bad. I think that's where I would disagree with a lot of folks, and generally on financial FinTwit.
Yeah, I think this second one is really, really good because everybody thinks low turnover is good. And low turnover is good from the perspective of less transaction costs and all that stuff, but it's a case-by-case thing. So like as a factor investor, I can say this because momentum requires more turnover than value. So in that case, in the case of momentum, higher turnover actually is good. And so it's more important that you look at the facts in terms of what you're seeing for your specific investment strategy rather than just saying low turnover is good.
I'll shorten it to this point. Make sure the good decisions you're making compound. And if that strategy is a lot of decisions or very few decisions, all that matters is that they're good decisions and that their positive outcomes compound. You figure that out, just don't screw it up from there.
So this next one is a great one for value investors because many value investors will say, all right, I see this cheap stock, it's staying cheap. I need a catalyst. Like I'm finally going to get my, multiple expansion when I finally get this catalyst and I'm going to make my money. Here's Scott McBride talking about why that's wrong.
It really is that. I just hear so much, what is your catalyst? What is going to unlock value? And for us, you really don't need a catalyst. What you need is to get the valuation right and to get the governance right. And, as long as the company is going to give you that cash back, you're happy. We're happy to have a low valuation. We're fine to sit at a low PE for a long time. If the management team does the right thing, that means we get a big dividend yield and they can buy back a lot of their shares and grow earnings really fast by doing it. So that's the number one thing that I see. People talk a lot about where I don't agree with it.
Yeah, this is very relevant in the world of Mike Green's research and the world of what David Einhorn has said, because we're not getting that multiple expansion anymore. But as a value investor, there's other ways I can get paid. I can get paid through dividends. I can get paid through buybacks. There's a lot of ways I can make money even without that catalyst. And value investors have had to focus on those types of things because we haven't been getting, even when we've been getting the good news, we haven't been getting the multiple expansion we got in the past.
I love this because this is just let the luck come to you. Have your process, have what you're going to do. Back to that don't get cute, get cautious idea. Get cautious, find the right business, find the thing that you want to own, and then let the luck come to you. You don't need the catalyst in the sense that you don't need to predict the catalyst. If you built in enough of that margin of safety, eventually you're going to get it. You just got to make sure that you got the right governance, management team, whatever else running the operation. Really great point.
Yeah, and I would have guessed when we asked Larry Swedroe this question, he would have done something around factor investing, and that's what he did. So here's Larry talking about low volatility.
This was a tough one for me to come up with one. But in my book on factor investing, we limited the equities to 5 factors that we thought people should consider. Beta, of course, value, size, investment, and profitability or quality. Profitability is just a subcategory. Now, actually, I put more money on the size and value and beta premiums because they are risk-based, at least to some degree. There is at least a risk. There is no logical risk-based story, I think, for quality and or momentum. Momentum, we know, is under overreaction. Quality, to me, the argument is simple. If a company is lower volatility of earnings, lower debt ratios, is a safer company, how can you argue that you should get a risk premium for it? But the data is so powerful that I don't ignore it. Okay. An investment is the same logic, right? So the ones I didn't really put in there, but came close to, was on low volatility. A lot of advisors emphasize this low volatility strategy, and it fails the test for me for one reason. First of all, it's purely has to be a behavioral story, right? Because if something is less volatile, that's certainly one measure, but not the only measure of risk. Okay, it's less volatile, it's less risky, and therefore should have a negative risk premium. So why do we have a premium? It's a behavioral story. Investors like to bet on these lottery stocks. They're higher beta stocks as well. High beta stocks have god-awful returns. Okay? But the data is strong. So why don't I recommend it? It's because volatility, as low vol, has only had a premium when it's been in the value regime. So I think you're better off owning value stocks that screen out the junk low profitability, focus on value that's more profitable, not high investment and stuff. So you don't get the other side of that behavioral trait. I think all you're doing is lowering your beta, and you shouldn't expect a premium. So low vol is good when it's cheap. Low vol is not good when it's expensive. This is a case, in my opinion, when I last looked at it, I haven't looked at it in quite a while, but when I last looked at it, all the money flowing into low vol had put it into the growth category. And guess what? Low vol has done poorly. That would be the one where maybe there's disagreement.
So, Matt, I'm going to try to provide some commentary on this because the next two after this, I got nothing on. So I'm going to first be throwing those to you. So this actually is very interesting, though, because I'm not a big fan of using low volatility on its own either. I think low volatility works really well when it's coupled with other factors. And Pim van Vliet's work has shown that. I think it works well with momentum. It works well with value. Larry talked about the idea that low volatility works. If you look at its excess returns historically, they pretty much come when it was cheap, in addition to the stocks being not that volatile. So I'm a big fan of this. I'm a big fan of multi-factor investing in general, but specifically with low volatility, I think it's a factor that works really well with other factors.
Yeah, pair it with other factors because like you said, low volatility, works when it's in that value camp. So if you understand when something that you think is interesting is in your sweet spot or works in a complementary way, that's when you want to put it on. But there's lots of examples of stuff like this where if it drifts into another category, it's almost like out of your domain of understanding. I'll always think back on the low vol stuff to when one of the low vol or min vol indices, I can't remember which one, you can correct me if you remember, was like all utilities and a couple of financials or something. And it was like, clearly if you're buying this as a weird expression of something that, you're probably not getting what you're paying for. And you got to be aware of that stuff. You got to ask the questions like he's pointing out here.
So this next one comes from one of my favorite interviews we've done because it was so outside. I learned a lot from it, and it's so outside of what I do. So here's Chris Sidial answering the question.
Yeah, so I actually think that this is a really, really good question. So trading psyche, in our opinion, is extremely important, but a lot of guys in the vol space are like quant based, and they tend to shit on that quite a bit. And I don't understand why, because I think if you go back and you look at some of the great traders that have come across, all these years, guys like Paul Tudor Jones, Ed Thorpe, Druckenmiller, all those guys talk about like how important your trading psyche needs to be. So it's probably a controversial take with like the nerds in the space, but probably an uncontroversial take with the people who actually have done well.
So Chris runs tail risk strategies. So, when you keep it in that context, you can understand what he's talking about here. Like, I don't do any trading, so I don't really understand much about trading psyche, but he's talking about why trading psyche is so important. And so I'm just going to throw it right to you, and you're going to tell me what you think about it.
Well, what I think about it is like, are we what's the difference between like trading psyche and like trading psychos? And there's something about
probably
it.
A big difference, I would bet.
There's probably a big difference. I'm going to have to get Chris, nailed down on this conversation if there's such a thing as trading psychos. But I kind of think about it as like, I want the Michael Myers. I want the serial killer. I want the person who's just going to like execute at all costs, like on this thing with the complete horse blinders up to understand what they're doing. And that's like a different level of nerddom that is, does it exist? Yeah, it probably does, but it doesn't exist in the ways that we paint some of these historical analogs when we tell these tales about what great trading psyche actually is. Chris is a really, really interesting guy on these topics.
Yeah, and I think what he's alluding to is really important too, because he uses discretion in his process and some quantitative metrics. And what he's getting at is that's very important. Like a lot of people are quantitative traders and they just, they just run the data and they do what they do. And that can work really well for the renaissances of the world. But for what he does, like this idea of managing your psyche actually is really important.
Yeah. Yeah. And again, like managing the psyche almost to like a ridiculous level where you're willing to break that model sometimes, where you're willing to have discretion sometimes with a thoughtful process behind it. And not to equate him to Michael Myers directly, but you get what I'm saying here. You got to bring that level of passion to it.
Yeah. And to be able to trade when the world is melting down around you, which is what tail risk people do is I can imagine a very difficult thing.
Yeah. Especially when you've been waiting for returns and you're finally getting some of them, how you have to know what to stick out versus when to get out. That's why I'm not doing it and probably why you're not doing it too.
So we had Kai Wu on, we talked about AI. And so he played into AI in his answer to the question.
Yeah. So we can kind of continue on this AI theme because why not? a lot of folks are pretty concerned about AI taking our jobs, not just in finance, but, at least in our industry, portfolio managers, financial analysts. So I actually wrote a paper on this. I actually wrote a few papers on this topic, of how will AI LLMs impact our industry and our jobs, right? And I think, the first thing to note is what I just told you guys, just now, which is that, I think that trying to use large language models to replace the kind of capital allocation component of investing. So in other words, hey, here's factors, you have 1,000 factors, find the best ones based on historical correlation with returns is a non-starter. I think that's actually not the way to do it. And I've written, papers on this, on why not. I think that the killer use case of AI, and this was the 2020 paper I wrote on where I said, you don't want to do the first thing, but what you do want to do is to use large language models as a way of structuring unstructured data. I specifically called out this technology and said that this is the killer use case. And I think, over the past 5 or so years since that paper came out, it's basically become like common knowledge, right? Most people will agree that what large language models are good at doing is, working with unstructured data. So now to take this to my point is, in my last paper on AI financial analysts, one thing I did was I said, let's look at the job of a financial analyst or PM. And you can decompose it into, say, 20 or 30 different tasks. These are individual things like, creating PowerPoints or mapping Q6, whatever, right? It turns out that you can then ask the LLM or figure out which of these individual tasks are better accomplished using a large language model and which are better accomplished using a human. And the results are intuitive, right? Talking to clients, building your business, that's human. Using creativity to come up with new investment strategies, that's human. Creating PowerPoints, that's better by machines, right? Proofreading, right? And so it turns out that about half of the tasks of an analyst today are better with large language models and half are with humans. And so you think about what our jobs are. They're just bundles of tasks. Where I don't see us kind of like net necessarily losing jobs. I just see like a repackaging of those jobs, right? You almost think of like a new AI enters the workforce. They take up the things that they're better at and you're left with the things that you're better at. Which, I think I'm pretty optimistic in general. I think that's actually a good thing, right? I don't want to sit here mapping QSIFs. I don't want to sit here building security masters again. I don't want to sit here proofreading a PowerPoint. I want to sit here like exercising high level thought and utilizing empathy and social skills to talk with other humans. So I think in many ways it's a positive development. And you think about the history of like the labor markets. Over the past 200 years, there's been massive technological change. We went from being 90% agrarian to 2%. Now, and despite that, the employment rate has basically been the same, right? Like there's all these new jobs that have been created because of technology. Pilots, right? Flight attendants, prompt engineers. And throughout this period, right, we've seen just a massive increase in the wealth of society. So I think yes, the jobs will be different moving forward, but we'll all be probably better off for AI. And, at least for those of us who are, thoughtful about comparative advantage, thoughtful about exercising, a development and training our ability in areas that AIs are less competitive. I think, we're actually, going to have a better time, doing kind of more meaningful work than in the past.
Yeah. So another one I'm going to throw to you, but I've thought about this a lot in terms of what AI means. And we talked to Cullen Roche in our latest episode about this, like what AI means for jobs and what AI does well relative to people. And, Kai's much more optimistic about the future in terms of a lot of people are like, oh, AI is going to take all our jobs and it's going to be a disaster. Like Kai's really more optimistic about the idea that AI is going to allow humans to do what humans do well. And AI is going to do what it does well. And it's really going to work out a lot better than many people think.
I'm with Kai on this, having talked to him about this. Eric Markowitz is another person who's thought really well, I think, about this, and it doesn't feel all doomer. And I am definitely also in the camp where it's like, will AI take some jobs? Yes. Will it take all jobs? No. So if you understand what are the some jobs that it might take or what are things that can do well, if you're a human who knows how to play with this stuff, it's probably going to help you with your career, on your track, whatever else. I think back to, we've got a million examples of this. The most recent one was just the advent of internet and the technology that we've seen come around today. I think about Kevin Weir talking about being the first guy who wasn't a computer nerd, but was enough of a computer nerd on the desk that he didn't have the comp sci degree, but he could build the index ARB models into a spreadsheet and then program the trading in Python or whatever the platform was that he was able to program the stuff into. He's like, I was just there in a sweet spot in time where 4 years before it was impossible, but 4 years after computer science majors took it over. AI, I think we're probably in a similar spot today. If you know how to do it, you can probably avoid losing your job and maybe even turbocharge some of your productivity, efficiency, and everything else. And on the other side of it, all humans are just going to be using this in some way, shape, or form or another.
So picking up on AI, another question is what's the impact it's going to have on the asset management industry? So Doug Clinton had a controversial take around that.
The bet that we've been making at Intelligent Alpha is that if we fast forward the clock a decade from now, that the AI-powered asset management industry will be a multi-trillion-dollar AUM industry. So just like we've seen this boom in ETFs and indexing over the past 20, 30 years, I think you will see a similar boom in AI-powered investing. Some of that will look active. Some of that might look a little more passive. Some of that might look even a little more exotic. But I think when we're here chatting in 2035, I think Cliff Asmus just did a prediction piece, 2035.
Yeah.
My prediction would be that we'll see a few $1 trillion being managed by AI.
Yeah, this is interesting. And I, to be honest, I don't have a huge opinion on this. I mean, he's saying that AI will manage trillions of dollars. And, you know, he's probably right eventually. I don't know exactly how that's going to manifest itself and how it's going to work out. And he's obviously making a big bet on that with the funds he's launched. But I would think, I mean, AI is going to be able to do everything a human can do, or many of the things a human can do. And so I don't see any reason why there wouldn't be very large AI-driven strategies eventually. What do you think?
Or are the AI-driven strategies just like the future of Vanguard and BlackRock? Or we're going to take those management fees down to -0. We're going to start paying people back to own these things because a robot is running them and they're not actually making any active investment decisions. They're just implementing the thing that's completely by the book to begin with. I don't know. I feel like there's all sorts of science fiction and some dystopian, some utopian versions of this, but there's no way that the next $1 trillion of managers in the future aren't going to be using AI to help them with their strategies, let alone turn the keys over in full.
Yeah, Vanguard has taken everything from the active investors like me, so they might as well take AI as well.
They might as well take it as well.
You know?
And
Yeah,
who knows?
exactly. This is just let them have everything. So as we said at the beginning, we're going to wrap up here with Meb Faber as well. So here was Meb's take on international investing.
You can look at a lot of industries and the top company is not in the US. And if you look historically, stocks by decade, it's super fun. You can find other decades where the list is dominated by other countries. The favorite example, of course, is Japan in the 80s, right? Top 10 market cap was mostly Japanese companies at that point, biggest stock market in the world in the 1980s. But look, I was joking on Twitter the other day. I say, I'm so bullish on US stocks. I'm going to put double the amount of any other stock market around the world. I say, screw that. You know what? I'm so bullish on US stocks. I'm going to put 5 times as much as in US stocks as any other country in the world. I said, actually, you know what? Forget it. I've just been watching CNBC, AI special. I'm going to put 10 times as much in the US as any other country in the world. I go, wait, congrats. You've just gotten to the market cap weight. All right. So like right there, 2/3 in the US, 1/3 in foreign. That's the market cap weight. That's the starting point, right? You have 10 times as much in the US as any other country. And, you know, my example though, with my friends talking about tech and whatnot, I mean, I was saying, looking at it, Ozempic and Novo and all these other countries, I said, I don't know why you would assume that big AI developments are guaranteed to be US companies. You know, to me, it seems like, you know, these discoveries, if you said this is coming out of China or India or Singapore or Brazil, Argentina, Africa, who knows? Anyway, but people would love to give me crap and say, Meb, this proves, last 15 years proves international investing doesn't work. I said, it absolutely proves international investing does work. Because if you were located in 49 of the 50 countries in the world, God bless you. You put 2/3 of your money in US stocks. International investing has been a screamer. There's only been one country that international diversification didn't help. And so I'll take that hit rate. 49 out of 50 to me seems like a pretty good batting average. So international investing has worked particularly good the past 15 years.
I think this is one of the most unique takes and probably the best take I've heard on international investing. And I'd never heard it before he said it, which is this idea that for everyone but people in the United States, international investing has been a massive success. And so when you look at it that way, it's hard to make an argument that I don't believe in international diversification when it's worked literally everywhere but in the United States.
This is such a perfect inversion of the question, where it's just like, you don't want international diversification here, but if you're anywhere else in the world, you would want it. And just acknowledge that reality for just a minute, and just say, hey, this is a fantastic thing. And not unlike the way that I really, really want a Mexican Coke this afternoon. And I sitting here in America, I'm sure the grocery store, I hope I don't know if tariffs have taken away Mexican Cokes yet, but like I can probably just go to the grocery store and get one. But like, I don't know how many people in Mexico are chomping at the bit for that synthetic sugar sweetness inside of a regular American Coke. I don't think it carries the same weight. I could be wrong, but I feel like there's a flip here.
Probably doesn't. And I think they are still there. I think I saw one the other day. So you can rest easy on that.
It's been a couple of weeks since I've had one, but in these trying times, Jack, a man needs a soda.
Well, thank you everyone for joining us. And thank you again to Meb Faber for coming up with this question, which we blatantly stole. And we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.